Recording in progress.
All right, good morning, everybody. Had some mechanical issues, so I started the stream a little early. I wouldn't normally do that. Hey, a happy Halloween, by the way, everyone. All right, so we can go ahead and get started, I think. Everything should be good. Audio up and running. Things fine. You never know when you change something different. All right, so just a reminder that these morning briefings are something that I've been working on for 2 years as a tool to teach other people how to do a morning briefing, right? The ultimate goal here is that you get to a point where you could do these on your own and you wouldn't need to, sign in and listen to me talk. You'd already have it under control. So I'm not trying to give you a fish. I'm trying to teach you to fish, right? But along the way, of course, what I found is there's no better way to teach it other than to just do it myself, do it live, and kind of deal with whatever we happen to come across, because there's so many diverse paths that we can take depending on the kind of news that we find on a day-to-day basis. So you're going to get a fish, but that's not really the goal, right? The steps that we take, the process, it's going to be the same thing every day. We're going to go through the same exact thing. So we're starting out here at Finance Juice. This isn't the only resource out there, but it's a free one, and it's a really good one considering that it's free. I do recommend that you sign up, though, because if you don't sign in, you'll have to make filter changes every time you want to use it. But if you sign in, you can save your settings. You don't have to make that change every time. It's free to make an account. I don't get anything for talking nicely about these guys. It's one of the best resources that you could get. And if you're not using it yet, you got to kind of ask yourself, why not? What do you got that's better than this? We got ECB speaker today at 10 a.m. We do have Chicago PMI. It should be a fairly light week up until Wednesday. Right? We shouldn't really have too much on the docket. Everything is still trying to balance out a little bit over on the European side of things. So we'll see. So right now I'm looking at the European market wrap. This market wrap happens after our market closes, after the Asian market closes. And even though Europe is still open right now, they're not closed. Finance Juice gives us an early glimpse of the European market wrap, knowing that Americans are getting up, kind of getting ready for the day. Which is a good thing to know when our market closes. If there was a move during the day and you don't quite understand why that move happened, and you go looking around after the market is closed, try looking here. It might be in the American market wrap. Grain right now is the situational crisis on hand. Keep your eye on commodities today. I know that it's not something that we talk about most of the time, kind of boring, but that is front and center. Same with the 10-year yields going parabolic. If you look at them on the week, though, we finally had a little bit of a pullback. CME Fed Funds Watch. Remember, you got to keep track of what they actually do, not what they actually say. Everybody keeps saying the Fed is going to hike 75 basis points, and that's what the market is anticipating. And yet that's not what they're trading. They're unwinding 25 basis points to take us from a 75 basis point rate hike on November 2 to a 50 basis point rate hike on November 2. The probabilities that we get a 50 are really low, but they're greater than they were a week ago. Right? They have been increasing the probability and decreasing the 75 basis points. We've seen this. Remember last week we were sitting at 95.5%. It was almost written in stone that we were going to get a 75 basis point rate hike, and then they started to unwind that in the past week. I want to continue to watch this through Monday and Tuesday, and remember that there's the Fed Whisperer, that Nick guy on Twitter. He's going to be their only way to communicate since they're in the blackout period before the report, right? So you won't hear from anybody other than, say, Yellen and that Nick guy. So if you don't have that Twitter account, I'll try to pull it up in a little bit. He's basically the shadow Fed voice. So, he's all we got. If they're going to try to throw us a curveball, it will come from that direction. For December, you can see that we're getting a little bit of an unwind off of the 75 basis points, because if you consider that we would be at 3.75 by November, and then we go from 3.75 to 4.5, that's another 75 basis points, right? And so they've been unwinding that from 54 down to 46. Actually, it had gone down to 43, and now it's starting to rise back up a little bit. So a little discrepancy there. But still an unwind from that default 75, 75, 75, 75. And of course, when they're unwinding it, that's a little bit of gasoline on the fire for equities. All right, as we do every morning, we stop by the calendar. Different places show different economic events. And these are not all of the events. There are a ton of them that you never hear about, you never see, they never hit the news because they're not glamorous and sexy and exciting. So if you look at a couple places, say FX Street or Econo Day website, Thinkorswim, if you look around, you'll notice that there's discrepancies in the economic events for the day. If your Thinkorswim looks very cluttered and chaotic and crazy like this, just turn everything off and then turn on Econo Day events. You can move these columns around, set the descriptions next to the time, and you can see that we have additional auctions today at 11:30. It seems like I'm the only one that ever talks about these, but I trade the SPX. I day trade that thing, 0-day trades, weekly trades, and these auctions from 11, 11:30, and 1 o'clock are absolute game changers. I always pay attention to these auctions, especially if they're bigger ones, say like the 2, 10, and 30 year, right? So today they're at 11:30. Keep your eye on the clock. The clock is one of your most powerful indicators, and it's another one that's free. I didn't want to have to go back digging for this, so I started with it already on my screen. We're looking at what I've heard before as the most impactful ratio chart. I don't know that I necessarily agree with that, but somebody made a pretty bold statement when they said it. Discretionary versus staple, and we've got a divergence here that the market was still running hard on Friday, or it melted up Friday, say it however you want. We went one way in the market, and the spread should have been moving with us, not against us. So we'll see which way the divergence plays out. I would anticipate that the ratio is right and the market is wrong. Plus, as we're going to be getting to here in a few minutes, I'm making the call that just like when I called the bear market rally back on the 13th, I'm saying that the bear market rally is just about done. We might get a little bit of an overshoot, but unless Powell comes out like a dove and starts singing like Prince, I don't see that we're breaking above call it 39.5, maybe 4 as an overshoot, and that would be all that it is. And of course, if we get above 4, I'm wrong. And hey, I've been wrong before. It's okay. We've got a 21-day ADR of 2.6%. That's just about $100. A nice round number. We don't have any market maker move. So from our current situation, you could see the extremes of the ADR. That'd be the COG line at 411 on the upside and the COG line at 3811 to the downside. Since it's $100, it just pretty much puts it right where we need to be to hit those COG lines. Half of the ADR is the red lines, 39.62 and 38.60. All right, down here at the bottom of the screen, we're looking at the cumulative overnight volume. We just look at it as a snapshot in time. And we're looking for really, really low volume, which would tell us the market is sitting on the sidelines waiting for something really big. All right, say it was monthly job numbers, CPI, PPI, something that would cause everybody to sit on their hands and wait. Normally, we know when the market's going to do that because it's econ and it's on the deck. But sometimes we don't know what's going on, right? We'll just see really, really light volume and there's no econ on deck. And it gives us a warning or a heads up that, hey, the market's waiting on something. The market knows something's coming that maybe we don't know. And we might not know what's coming, but we can see that something is because there would be really light volume. We're a little shy today, less than 100, but that's not light enough to be a concern. And on the other side of it, if it was really high, say above 250, getting closer to 300, that would also be a concern. So we're looking for really, really light or really, really heavy. If it's in the middle, like Goldilocks, is fine, right? No big deal. Now we just turn the darn thing off because it's a big lower indicator. It just takes up a lot of space. Volume's a little light, but still within range, still within normal levels. We are inside day, which is not much of a surprise after the move on Friday. And at the moment, we have an MDP. That's a missed daily pivot. We call it an MDP because the daily pivot is down here, and we haven't hit it yet. So MDP, missed daily pivot. It's not my strategy. I didn't develop it. I didn't design it. But if you were to go looking on the web for it, I'm sure you would find a lot of different examples of how to trade it or how to use it in your analysis. Markets hit their floor pivot more than 80% of the time. So when it doesn't hit its own floor pivot, kind of stands out, right? And it becomes something that you can use to your advantage. So at the moment, we have an MDP. Depending on how the day unfolds, we might come down and tag that thing anyways. We are above the weekly pivot, so we're starting the week bullish. Not much of a surprise there after the grind from last week. The expectation for the week is that we're going to hold the line at least until Wednesday. Now, that doesn't mean that we're not going to go down any or that we're not going to go up any, just that we're not going to really make another leg somewhere. And if you think about it, say, from this range that we had been in, and we finally left that range, and we got a new leg up, we're in this new zone with a 50% retracement from that August drop. We're there. All right, so we wouldn't expect to get back above or get above that 50% retracement. If we do, it'd be, an expectation of a fleeting moment. We wick up in there, close back down by the end of the day, and it would be end of day data that we'd really want to focus on, right? Not the idea that we can break outside of Friday's level to the upside, but that we would keep it or not would be the more important thing. And still staying below 39.5. Most definitely below the 618 at 4,000. If we get that high up, then my call out that the bear market rally is done will be wrong. So we are coming into that resistance. If you were to tie these two pivots together, so the expectation for today, if we're going to hold the line, that makes everything from Friday fair game. It makes this entire range, which happens to be a very large range, unfortunately, our range for the week until the report, right, until Wednesday. So we're talking from 37.5 all the way up to 39.5. That's 200 points. So that's going to make it difficult for iron condors and things like that to try to run it for 3 days. But on a day-to-day, maybe not so bad. We're still really wide, though. All right, that's going to be kind of the hardship on running those. We still have our gap from Sunday night, so we could have an expectation of a gap close, 39.15 up to 39.24. That would be breaking out of our own Globex high and getting back up to the high of yesterday, the high of Friday. And depending on where you consider the market had closed, then the gap is basically done, right? It would depend on, do you want to use the 4 o'clock close, the 4:15 close, the 5 o'clock close? A way to resolve that discrepancy for yourself is just use whatever the broker used. So if you go out to a daily chart, that is what your broker says is the close. Kind of just solves the problem, right? Whatever they used to have a close on that candle, it might be 4, it might be 4:15. So with that yellow line that I drew, 39.23, we have not closed the gap yet. All right, 10-day, 30-minute volume profile. We're at the top of the box. When we're at the bottom, we expect to go to the top. When we're at the top, we expect to go back down to the bottom. Should we fade lower through the day here today, we've got some volume support around that 36.50, or excuse me, 38.50. But remember, this isn't the kind of support like a handrail. You're not going to want to lean on it or trust it. It'd be more of falling out of a tree and hitting a lot of branches on the way down. Right? You don't expect all those branches that you hit to actually stop you from falling. It just might slow you down a little bit. It'd be the same thing here. If we do come in to the 38.50 area and then break through it, we've got a very large air pocket of risk. We can fall through shallow zones really fast. So that's kind of the danger there. It's interesting to note that the pivot point from last week, say Wednesday, there's no real volume support there, right? And how we carry forward pivot points, open, high, low, close. When we carry those forward, we usually have an expectation that should we hit it, we'd probably get at least a first touch bounce play and maybe find support. But there's no real support there to that pivot. And the same with the other ones, say from Tuesday afternoon and Thursday. Nothing really there either. All right, so should we break our own Globex low this morning, we've got nearly a straight shot back to 38.50 without a lot of stuff to arrest the fall. All right, 5-day, 5-minute volume profile. Catching these on a day-to-day basis, carrying forward yesterday's value area high, value area low, and point of control. At least that's what they tell us to do, right? If you were to study how to use a volume profile, that'd be one of the things that they would tell you to do. I don't carry the value area high and low forward into our day because I'm already usually marking those levels as the high of day and the low of day. What I do like to carry forward is the point of control until we've hit it. And once we've hit it a few times, there's no reason for me to keep it marked. I continue to leave those on the chart until we get back to it and hit it. All right, so like on Friday, we had a VPOC we talked about in the pre-market. Through the morning, we ran up and we hit that VPOC, took it off the board, and now we don't need it on the chart anymore. We've got one overhead at around 4,000, and I believe we got one underneath this, yep, at 3,600. Neither one of those are a concern for us today necessarily. I mean, I don't expect that kind of chaos. But we don't really have anything to carry forward from yesterday because we've already gone through that point of control a few times. So nothing to carry forward from yesterday. Looking at the volume from yesterday, there is a little bit around that 3880 area. So that could kind of slow us down a little bit. And it lines up with a previous pivot point that I keep marked. It's from the last FOMC meeting. It's one of the 4 pivots, open, high, low, close. Considering I can see one here, and one here, I would say it's not the high and it's not the low. So it's either, the open or the close. It doesn't really matter which one that it is, just that there is one, and it lines up with that volume that we're looking at. So we could get at least a first touch bounce if we get into that 3880 area. All right. On Friday, when we were looking at this, talking about the new range for the week and how wide it was this week, we had not yet crossed through this blue cyan line. But that blue cyan line is an anchored VWAP, starts at the first of the year. And we've tried to get through it earlier, say back in September, in the earlier part of September when we pushed up through it. Let me back this thing off. I don't think we've got enough days. There you go. All right, so that looks better. We're not through it yet. Having it zoomed in like that messes the math up on that thing. And I was thinking, man, we weren't there Friday. All right, we're still not there. With the size of the volatility this week, however, on Friday when we talked, since the market had not yet closed, the size of this box was not yet set in stone. It is set now, obviously, right? Because the market closed Friday. Look at the size of the volatility projected for this week compared to what it was last week. So the market makers actually got one right this time and increased the volatility anticipation for the week. They've been getting it wrong, consistently wrong over and over. And hey, they got one right this week. So the spread on the box, it's a bit wider. I would say the high end of that is just about spot on for the week, 40.33, at least until Wednesday, right? Because after Wednesday, all bets are off. How far from the 10-period moving average we are? Talked about it Friday. We were getting right up into that zone where a pause or a reversal was on the deck, and now we're getting the beginning of that pause or that reversal. So that's the 10-day. We still need to flip this over and look at the 10-week. We're above the 10-week, not by much, and nowhere near any level of extreme. So we got plenty of room, believe it or not, to still run to the upside if we're only gauging how far from the 10 we are. So this kind of goes into my argument that there could be a little bit of an overshoot. The high of Friday does not have to be the end of it. I say we're done with the bear market rally, but that doesn't mean we can't grind a little bit to the upside. All right, so that covers the S&P, covers the normal things that we would look at, and we bring in the VIX, settlement contract changes, the dollar getting back above that critical level that we've been talking about lately. When we got down below 110, right, things were getting a little crazy. The Fed's mandate to, land us in restrictive territory is supposed to cause pain. And we're supposed to see the market kind of hold the line and be stable, not get a joyous rally to the upside. And when that dollar got below 110 and we were getting that nice little rally off the lows. It just kind of, it goes against everything that they were doing, right? It kind of says that all the pain that they've been causing is for nothing. So seeing the dollar back up above that 110 is a good step. Bitcoin managed to kind of stabilize and keep up there too. My call on that is still, it's still looking for a 50% haircut. That's 50. Right? We're still looking for that thing to get down to around 10. Gold flat to stable. And crude, you know, with the elections coming up, the suppression of price at the pumps, it's the standard manipulative tactics, all right? No matter who's in office, no matter which side, always artificially lower the pump prices during an election because it helps whoever's in office. But that also skews our inflation reports, right? It plays with the data too far. The ripple expands into other territories. So after the November elections, and they are no longer manipulating the pump prices, you got to kind of expect that they're going to go up. Plus, we'll be in the holiday season, and you know, fuel rises during holidays. The January inflation readings are very likely going to be just absolutely brutal. And it's going to show that we're not yet in restrictive territory enough. Right? And the Fed has made it clear they don't want one data point that says inflation is abating. They want a continuous trend that inflation is abating. Right? It's the old horror story, you know, when you get in the movies, when they get the bad guy down and he gets back up, right? And they think, oh, the bad guy's dead, and it gets back up again. That's the inflation situation. They got to make sure it's dead. So in January, we're very likely going to be getting another leg down. But before that, you know, we got Santa Claus rally and all kinds of other things on deck. Just keep your eye on crude. It's very likely going to be front and center, especially with the grain situation going on right now. So commodities and crude, hand in hand. All right, I know it's a busy chart, but it kind of gets it all done. After all the work that the Bank of Japan did last week to defend their currency, and remember their benchmark is still 145. We are still above 145. We bounced off of that thing last week, stabilized, and now we're running right back up again. So all the work, all the money, all the effort that they put in to defend their currency was for nothing, at least so far. So keep your eye on the dollar Japan pair. That's going to have a direct correlation to everything that's going on because it will directly affect the dollar. If you go back and look on the day where they were doing a lot of that defense on 10/21, you can see that was the day the dollar had that hard move to the downside, and it was the day that the S&P and the NASDAQ and everything else ripped to the upside. It was a Friday ago, and it was a double intervention, right? We had that going on, which gave us a rally boost to the upside. And then we had that Fed whisperer, that Nick guy on Twitter, intimating or giving the wink and a nod that the Fed might maybe be potentially thinking about having a talk about a pivot. And that's all that it took. Those two events 2 Fridays ago was that rip to the upside that we got. So you got to think that maybe the Bank of Japan is going to come back out and give it another go, right? When you're in the ring and you're boxing and you got your opponent against the ropes, you don't back away and let him catch his breath. You come back in him hard and fast. So kind of what we're expecting out of Bank of Japan. So keep your eye on that currency pair. You want the pair to go down if you want the S&P to go up, right? That's just the most basic and simple correlation that we could put it together. If you notice, a few days later, China did the same thing, defending their pair. But China also told their state banks to start buying stock. And unlike here in America, where we would have those conversations behind closed doors with a wink and a nod, over there, the banks have to do what they're told. And they were told to buy the ADRs, right? So Baba, Baidu, PDD, NEO, JD, the buying flow has been like a river, just steady and soft buying pressure under the surface ever since. And that was, I think, the 26th. It might have been the day before that. Either way, all the defense that they put in hasn't done them any good either, and you got to kind of look for them to try it again. It'd be interesting if these two could actually synchronize, but that's not going to happen. They're not going to work together. Euro's back below parity again. And remember, we're not done with that. Just getting back down to 0.975 is going to be a good start, but breaking lows and heading lower, that's what I'm looking for. Everything stabilized in GBP. They've swapped government again, and maybe this will stick. Things seem to be stabilizing. Liquidity's back under control, so we'll see. All right, so some lines in the sand right now. As long as we're maintaining above 110, we can expect the weight against the marketplace. Not enough to necessarily push us down, but certainly be restrictive and hold us back from rising higher. If the dollar breaks back down below that 110, we're going to expect the S&P and NASDAQ just break into a whole new leg up, right? So we were in that box in the S&P. We legged out of it, got it to 3,900. If we break below this 110 level, look to go from 39 into, say, 4,000, maybe 4,100. We're talking close on the day and close on the week, not just, intraday we wicked down below that level, right? And we've already come up out of that in a classic double bottom the way it's exactly supposed to be. I mean, that is textbook, beautiful, perfect double bottom. It went lower than the previous low, trapped those traders in there, and then ripped to the upside, squeezing them, making them buy back their short positions, which gave us that really big candle. Right now we're getting our follow through. So we shouldn't go back down to that 110 in this cycle. Should just continue to make that move to the upside. Restrictive and punishing levels would be if we start to get above that 114. So that's going to be like where you would want to set your alerts, and through 115, that's likely to start breaking things depending on how fast we get there, right? So it's a relatively decent range between 114 and call it 111. And we maintain inside of that without too much extreme ROC rate of change, should be fine. We shouldn't leg down into 3,700 area, but we most definitely shouldn't be breaking back above 39. And the VIX on the day, that was a significant price drop on Friday, right? It was a nice Marbozu candle if we just pretend there's no wick there. And I'm pretty good at pretending. Maintaining above $25. This thing is broken. It's been broken. We've talked about it a lot this year. There is a lot of discussion going on right now about changing the VIX formula because of the impact of the SPX swapping over to 5 expirations a week. Remember, the options market is an experimental market, right? The S&P 500 SPX. Every new thing that they try, they always start there. For nearly a decade, it had 3 expirations a week, and it was impactful. It was really impactful. They had to wait a decade to see how much it affected everything because they just didn't know how much it was going to break things. Well, now we've got 5 expirations a week, and it's breaking things. They don't know what to do about it yet. But one of the things that it's breaking is the VIX. The VIX, in its simplest form, is a representation of volume in the options contracts on the SPX 30 days out. Well, all the options trading right now has moved to the very front. I can't remember the exact number, but I'm going to lowball it and call it 60%. In my gut, I think it's 80, but I don't want to say 80. I'll say 60. 60% of all of the options traded right now are in the very front. If nobody's buying the 30-day VIX or the 30-day SPX, the VIX isn't going to respond correctly. It's not acting right. So there is a discussion on the table about changing the formula, which hasn't been changed in a while, but it has been changed before when we swapped from using the S&P 100 to using the S&P 500 and a couple of other small changes in the formula. Until then, using the VIX as best we can. I still argue you're better off just using the VIX futures. But if the VIX breaks below $25, expect another leg up and a significant rally leg up in the S&P. Really want to see this hold above, say, 26. If we get above 30 and a quarter, or say 31, then we're going to start getting into a more brutal level of punishment, depending on how fast we get there. Right? So kind of those legs in the sand again, or lines in the sand. Below 25, look for a leg up, and we'll call it 30. Above 30, look for a leg down, at least down into that 3,700 area. Right? We're not talking about going back to year-to-date lows, not unless we get above 35. It does look like we're starting a new cycle again. And now that I'm out here on the weekly, you can see that algo work is pretty impressive. All right, UNG. Another classic bottom example. We are looking for this to stabilize. There's a whole lot going on when you start getting into global markets and energy right now, right? Between, say, all of the manipulations that they're trying to apply to Russia, what's going on over in Germany, Europe, just the entire space, just getting into oil, gas, coal. It's a mess. If we can stabilize here on the week and get proof of that double bottom kind of unfolding the way it's supposed to, could start looking for a breakout to close this gap up here. 2230 would be the gap close. Until we actually get outside of that red candle, however, it's not necessarily all that great of a play. So getting in as low as you can would be the best possible outcome. That way you can tell if you're wrong. Because if you try to go long and we fall through the bottom of that red candle, you're wrong and you can close the trade. But if you wait to get in somewhere through the middle, how do you know what wrong looks like? Where do you know where to get out? So we've talked about measuring big candles before. You could just measure that weekly candle, look for us to close above the 50% mark, and that would be a great place to start a position, because once we close above it on the week, we should not get back down below it, and that would be your line in the sand to say, I'm wrong, I'm going to get out of this position. So that would at least get you from the 50% mark up to around $22. And of course, with credit spreads, it doesn't matter if it runs or not, as long as it holds above that pivot point, right? So you could try to kind of fade your credit spreads from being close to the money or at the money or straddling the money to being out of the money. Should have a new reversal on BITO. That's the Bitcoin ETF. Be lining up on that soon. All right, KWeb. I don't really trade this. It's more the idea of using this for like an indicator. This is China Internet ETF. This is a really great way to keep track of like short squeeze, short float. If we start to see a short squeeze, we very often see this kind of make gapped up, ripping moves to the upside. So it's just a nice little squeeze indicator for, you know, those short covering rallies and things like that. We got nothing there, and that's pretty much all we need to see, right? That it's not making any kind of aggressive moves to the upside, and we're not seeing that unfold yet this morning. No real expectation of it doing that either, right? So emerging markets, think of this as global money. If they're feeling frisky and are willing to take risk today, if they were bidding in the market, this would be up. If you go and look at the components that make up the EEM, emerging markets, China's in there a lot, which doesn't make sense because I could have swore that they were no longer classified as an emerging market. But besides the point, they are still in this. So it's another reflection of the activity that comes out of China. It's a huge amount of money, right? So again, risk on, risk off. If this ain't bid up, then global money isn't feeling froggy this morning, not getting frisky, aren't looking for moves to the upside. So on Friday, we had finance and technology working together. It wasn't either or, which we've seen a lot lately. I would look for that to change today. Look for us to go back into the battle right now between tech and finance instead of tech against finance, vice versa. So we got KRE on the left and NY Fang on the right. NY Fang is a representation of the monsters of tech, and there's a massive divergence right now between them and the rest of the tech space, right? Which is throwing off all of our breadth levels. Because normally those 9 names can carry the entire index. And if they decide to call it, I don't know, pajama day and sit back with their feet up like they did last week, the rest of the market either has to carry everything or we go down. And we went up, right? That's where all that breadth came from, was everything else. It sure wasn't from Microsoft and Google and Tesla and Apple and everybody helping it. So keep track of the monsters of tech and see if we're going to get that turnaround or not. And that's the divergence that we see between the NASDAQ and the S&P. Since the NASDAQ 100 does not have financials in it. All right, we're just about done. So, stock screener, we want to kind of ask that question. How many names this morning are down a half of a percent or up a half of a percent, whichever way we want to go, right? And we're going to go to the downside. So we'll start with the S&P. How many names in the S&P are down at least a half of a percent? 21. Well, since this is the S&P 100, we can swap that into a percentage, and we can say 21% of the S&P 100 is down today. Down at least a half of a percent, and that's not that bad. We're kind of sitting in a neutral state, and we know that just by going out and looking at the market right now. So not a real surprise, but which names are on the list? The monsters of tech. So we see Facebook, Google, Tesla, Microsoft, Apple. It's the monsters. They are the ones that are down this morning. And of course, there's other names in here. We got some financials, Morgan Stanley, MasterCard, right? Some energy names. But for the most part, what stands out is that the monsters of tech are down this morning at least a half of a percent. So let's ratchet it up a notch. How many names are down at least 1%? Only 7. Well, that's not bad. And none of them are the monsters of tech. AMD has earnings this week, by the way. So what we're looking for is a highly correlated coefficient, right? If you got 99 names all doing the same thing, the market can get really dangerous and it can make really big moves. NASDAQ 100, same discussion. How many names in the NASDAQ 100 are down? More than a half of a percent, 25. It's 100 names. We can turn that into a percentage. 25% of the NASDAQ is down more than a half of a percent this morning. Of those names, does any particular sector, industry, sub-industry stand out? Say like semiconductors or the monsters of tech or anything like that. Some China names in there. JD, PDD, Baidu. I don't see Baba in there this morning. And then, of course, we got the monsters in there. So it's interesting to see those China ADRs. Those state-run banks were told to buy, and we're seeing them down this morning. So how much they're supposed to buy or when they're allowed to stop buying, I don't have that answer. I don't think it's been made public either. It's something to keep your eye on, though, right? If you're looking around on Twitter, maybe put one of those names in with a hashtag. See if you can find any kind of news coming out from anybody with a Bloomberg terminal. Maybe they've caught wind of something new. It's a great place to start, right? All right, so we got the S&P 500. It won't let me look at the S&P 100. There's no choice for that, right? So S&P 500, but we can use the filter. So we just use the filter, adjust it by market cap, try to get it around 100 names. I think right now 92 is about as good as we can get, and that is good enough, right? Close enough. Adjust the color scheme so it's a little more responsive. That is a really beautiful snapshot of what's going on this morning. Amazon slightly green, but not enough to count. Basically everything down in red. Not much of a surprise, though, right? I mean, not really. Tesla down a half of a percent. The monsters of tech stand out here. They are the biggest boxes on the screen, right? Because these are shaped by market cap. So monsters of tech, Apple down more than a half of a percent and closer to 3/4. Apple 3/4. Google nearly 1%. So there's your monsters. Tesla 0.5%. But that does not mean we're going to go down necessarily. We can easily hold the line if the rest of the market stands up, right? But if the rest of the market does not stand up to do their part, then we're going to leg down. Legging down would be breaking down below Friday's low at this point. NASDAQ 100, pre-market. We don't need a filter because there's already 100 names. We'll just adjust the color scheme a little bit so it's more responsive. Intel slightly in the green, kind of probably a little bit of a overshoot, just some drift. Nothing really stands out, and that's kind of what we're looking for, right? The monsters stand out, obviously, but we've hit on that. There's still a lot of flows coming in on the marijuana sector. A lot of news connected to that over the last 6 weeks. It's going to be the same argument for me now as it was a year ago, year and a half. There's this real estate name connected to the pot industry that I like. And if you're going to get into messing around with the pot names, dig a little deeper. Know where that country exists or where that company exists, what country it's in. Is it a Canadian pot stock company? Is it an American company? And then what are they focused on? Oils, edibles, medicinal drinks. Right? There was talk about, a relationship with Budweiser and Pepsi getting into the space. So, know your product. Now, if it's just a day trade, who cares, right? You catch whatever's moving with the flow and run the candles. We're talking about more of a swing trade position. The trend is very clear. I mean, there's no argument about that at this point. We're trying to get through that 10-period, 10-week moving average. Over that, we've got the 20, and then beyond that, we've got the year-to-date anchored VWAP. So, I mean, there's space, there's room to the upside, but there is so much resistance in there too. And a lot of this stabilization that we've had in the last month is based on that news. So, approach with caution. If you're looking for a solid long-term investment, looking for a swing in these back to the upside, it's not time. Because if that's the kind of trade you're looking for, you need a full set, and we don't have a full set. Gold's not ready, so I mean, there's still a little bit of opportunity for it here and there, but we don't have the signals for a new gold play yet. It's a little too early for crude to be popping. Still expect that to be suppressed until after the elections, but we're getting really close. And we're getting really close to breaking that year-to-date anchored VWAP, which is that fat white line right there that we bumped our head on last week. So for crude, we could use something like a TRB. Say something like that. You could use the other pivot and catch it a little sooner, but still look for a TRB. That would be already above the anchored VWAP. We're already through the 10, the 20, the 4, the 50, the 200, so we don't have any of those to worry about. And that's a wrap for me, guys. Y'all take it easy. Be careful. Be safe. Watch the clock. Remember, we have additional auctions today, 11:30. And I'll see y'all tomorrow.
Recording stop.